Hello and welcome to Business 360. I'm Arundhati Ramnan and here are the top headlines that we're tracking for you this evening. Stock markets end in the red after a range-bound session. Sensex loses nearly 200 points. Banks and mid-caps also take a hit. Rupee weakens marginally against the dollar. Asian Paints misses estimates in the third quarter. Management says extended monsoon affected sales in the festive season. Volume growth remains flat even as margins beat estimates. The union government proposes big changes to the insolvency law that could spell relief for real estate developers with stressed projects. It has proposed that it would be the adjudicatory authority's responsibility to complete the process of ascertaining default and ruling on the admission of insolvency process within the mandated 14-day timeline. Infosys is on the prowl. CEO Salil Parekh says valuations have become more reasonable and the company is actively scouting for acquisitions, adds that the deal pipeline is stronger than it was 12 months ago and expects to continue the good run in Europe. That's an exclusive. The Reserve Bank of India has big plans for its proposed digital currency. It is targeting getting the interbank call money market to be traded via CBDCs. Banking sources also tell us that the central bank is considering allowing digital currencies to be used for transactions even without being linked to a bank account. Payments and financial services unicorn PhonePe raises $350 million from General Atlantic. The company is now valued at $12 billion, higher than Swiggy, Polygon, Oyo, Dream11, Razorpay and Ola. Top pharma companies approach Bombay High Court, seek clarity on treatment of free samples and gifts under GST. Pharma companies are of the view that free samples and gifts are input costs and hence should be entitled to input tax credit. The sports ministry steps in as wrestlers protest against federation chief and several coaches over allegations of sexual harassment enter the second day. The Wrestling Federation has called for an emergency annual general meeting of the Sunday. Federation chief Brij Bhushan Singh has denied the charges.
I am human. Politicians are human. We give all that we can for as long as we can, and then it's time. And for me, it's time.
New Zealand Prime Minister Jacinda Ardern announces that she is resigning 6 years after she took office as then the world's youngest female head of government. She says she no longer had enough in the tank to do the job. Well, the top story, Hindustan Unilever has reported its third quarter numbers and we have Mangalam Malu joining us now to decode those numbers for us. Mangalam, how is it looking?
Well, the numbers aren't looking particularly bad. In fact, they are largely in line with street expectations. The revenues have actually grown a tad better than street expectations. The company's revenues have grown by about a little over 16% odd, 16.3%. The street was working with a 13.5% sort of revenue growth coming in for the company this time around. I'm just looking at their EBITDA as well. 3,537 crores is a little better than street expectations. In fact, the street was working with a number of around 3,500 odd crores. So there has been a mild beat on the EBITDA as well. Margins 23.2%. The street was working with a 23.6% sort of number. We have seen an improvement, quarter on quarter by about 30 basis points. But at the same time, year on year, it is a mild decline. But that was, again, on expected lines. Importantly, the volume growth of the company has come in at 5%, which again is largely in line, but mildly on the higher side as against street expectations of 4 to 5%. They've come in at close to 5%. If I take a look at their home care business, that's grown in excess of 20%. That's a positive. Beauty and personal care too has grown in double digits. That's a positive as well. And foods and refreshments is another business which has grown well for them. So those are a couple of factors which stand out to be mildly better than expectations. So overall, these numbers, while they look good, the higher end of expectations, they are, something that the street will like. Importantly, I'm just looking at the management commentary out here, and they say that they've hit yet another quarter of solid all-round performance, delivering double-digit revenue and earnings growth. Looking forward, they're cautiously optimistic in the near term, but importantly, they believe that the worst of inflation is behind the company. This should aid in gradual recovery of consumer demand. They remain focused on managing their business, of course, with agility, growing their consumer franchise. And they are, the management commentary also is cautiously optimistic, saying that inflation is the worst of inflation is behind them. So that is something that the street will like. The stock was largely lower in today's trading session, ahead of the numbers. In fact, was down 2.5%. It's corrected about 7.5% from the highs. So let's see whether the street will be positively surprised by this performance or not. But if you've just joined in, let me tell you, HUL in the third quarter has reported a turnover growth or revenue growth of 16%. Street was working with a number of 13.5%. The volume growth has come in at around 5%. Street again was working with a number of anywhere between 4 to 5 odd percent. And the net profit for HUL this time around has grown 12%. The street was working with a number of a 10% growth out there. Home care delivered a 32% growth. Beauty and personal care grew 10%, whereas food and refreshment grew by about 7%, led by robust performance in foods, coffee, as well as ice cream. The important part to watch out for now is how the demand situation is panning out, and at the same time how the company plans to scale up the recent acquisitions that it made. We have with us Amnish Agarwal of Prabhudas Leeladhar joining in to decode these earnings. Amnish, how do you read these numbers, especially the 16% revenue growth, 5% volume growth, and the fact that the management says that the worst of inflation is behind them?
As the numbers are broadly in line, we were working with 4.5% volume growth and roughly around, say, 15% top line growth. So I think numbers are good, broadly in line. And again, as has been happening, it has been led by strong performance in the home care, while personal care and food, they are tepid. I think as far as your margins are concerned, I think the commentaries are very clearly visible even in the past, because your palm oil prices have come up the highs, even packaging and crude are down. I think the worst of inflation is definitely over, and as we go along, I think the margin expansion on a YOY basis also should set in for within a quarter or so.
Right. Amnish, there is another important, announcement that has come by as well. The board of directors of Hindustan Unilever have approved the proposal to enter a new arrangement with Unilever group entities for the provision of royalty that they give to them. That royalty, which was 2.65% in FY22, has increased to 3.45% of the turnover. This will be effected in a staggered manner over a period of 3 years. We need to know the glide path for that. But, this is something that the street may not like. In fact, now it turns out to be that the numbers have become a bit of a sideshow. The other announcement that has come by, the increase in royalty to the parent, Unilever that is, will come in from 2.65% of the turnover to around 3.45% over the next 3 years. How do you view this? Because, this clearly eats into the margins going forward.
Yeah, you see the increase is roughly, you can say 80 bips over a period of 3 years. Okay. But more importantly, one has to look at in, I would say, 2 phases to it. One being that if you look at the categories like personal care or home care, where lever is today is because of the technology strength which it gets from the parent. Okay, so that clearly is an advantage. But if you look at the recent acquisitions, whether it is Indulekha, whether it is Oziva or some of the other, you can say, acquisitions, they are not entirely dependent on the technology of the parent. So I think in this scenario, when we already are witnessing a situation that because street earlier was even expecting their margins to go to 25, 26% kind of a number. I think in this scenario, I think with 80 bips royalty increase over the next 3 years, definitely the incremental margin expansion from here on will definitely be hit to some extent. And the state will obviously not take it very positive.
Exactly. That's the important point that you've made out there. The street will not take that point positively. The numbers are broadly in line, mildly better than expectations. But the joker in the pack has been this announcement of increase in royalty. Thanks a lot, Amnish, for joining in. We will shortly be joined by the management as well, who will detail the quarter gone by, and we'll obviously quiz them about this royalty change too. But for now, the word on HUL is that the results largely in line, mildly better than expectations, but the joker in the pack is the royalty, which the street will not like. The royalty for HUL, the royalty that it pays to Unilever, will increase from 2.65% to 3.45% of sales over the next 3 years. Back to you.
All right, so numbers not looking bad there, mildly better than expectations. Thank you so much for those details, Mangalam. Now, on to the day's market action. Dalal Street saw minor cuts in a range-bound trading session. Sensex lost almost 200 points and the Nifty declined by over 50 points. And shifting our focus to the commodity markets, crude oil prices fell today after industry data highlighted a large unexpected increase in U.S. crude stocks for the second week. However, Fatih Birol of the International Energy Agency told Shireen Ban in Davos that the China reopening and a likely economic rebound will push oil prices higher in 2023. Take a look.
There are a couple of uncertainties which could push up the prices, and among those uncertainties, for me, the most important one is China. Because last year, China's oil and gas consumption declined for the first time in the last 40 years. And China is the largest oil importer of the world. And if this year Chinese economy rebounds, which everybody expects as a result of reopening, it will put upward pressure on the prices. And if the producers do not respond accordingly in terms of opening the taps, we may see difficulties in the oil markets, and we may see prices going further up.
Meanwhile, Asian Paints reported a weak set in the third quarter. The company's net profits came in at close to 1,100 crore rupees, a 6% rise from the previous fiscal. However, the numbers were below estimates as extended rains in October impacted demand. Operating margins improved, driven by a cool-off in raw material prices, but domestic decorative volume growth came in flat versus an expectation of 5 to 6%. The company also witnessed a slowdown in its bath and kitchen business. Domestic air passenger traffic rises 14% at 12.7 million passengers in December versus 11.2 million passengers in the same month last year. Yearly traffic for 2022 stands at 123 million passengers versus 144 million passengers in 2019. So it is yet to reach pre-COVID levels. Indigo's market share fell to 54.9% versus 55.7% in November, while Air India's market share rose to 9.2% versus 9.1% in November. The government has been proposing some big changes to the Insolvency and Bankruptcy Code. The proposed amendments could spell relief for real estate developers with stressed projects. Sapna Das has all of those details. Sapna, what are you picking up?
Well, first of all, what is being suggested is giving a 14-day mandate to the adjudicating authorities in terms of either accepting or rejecting an IBC plea. Basically trying to expedite the whole process. Second, of course, in terms of the real estate projects, some of the units which are under stress, so the amendments propose separating those stressed units which need the IBC proceedings, separating them from the rest of the entity, because the rest of the entity is completely functional. But many a time, suspicions are cast because just one unit has defaulted, so people look at the entire project in askance. Government here is trying to separate the two, and I think this could be a boost for real estate developers facing some kind of a stress in some of the units. Apart from this, of course, trying to expedite the pre-packaged insolvency framework also. What is being suggested is that the voting for the COC, that can be reduced in terms of accepting such applications under this framework from 66% to 51%. And also bringing more CDs under the pre-packaged insolvency framework. Of course, these CDs are going to be prescribed, and I'm sure the government will come out with more rules and notifications once at least these basic amendments go through. Apart from this, it is also being suggested that the corporate debtor will not have the power to appoint the insolvency professional. This will now be done if the amendments are accepted by the IBBI, which is actually the regulator for IBC. Also, the pool of assets of a corporate debtor's guarantor, that should also be included under IBC. Apart from this, the government is also trying to strengthen some of its own powers. For example, it is being proposed that they should have the right to appoint an administrator under IBC. The work will work as per the code, but the COC will not have the power to remove or replace such a government-appointed administrator, and all the work will be handled by the administrator. Last but not the least, the government is also trying to suggest that some powers should be given under the code to exempt a certain class of companies from the IBC. Maybe a separate kind of a window should be thought about them. No details as such, but maybe something will follow through in rules and notifications. All in all, the public comments to these important amendments are invited by February 7.
HUL just came out with its third quarter numbers. The management is addressing the media, so let's cut across.
To more than rupees 10,000 crores. Net profit at 7,410 crores grew 14%. Let me now talk about our new royalty and central services arrangement with Unilever. Our current agreement, which was signed in 2013, grants HUL the right to use Unilever-owned trademarks, technology, and gives access to central services by Unilever Group. This arrangement has equipped HUL to meet emerging consumer needs with agility and win in the marketplace. During the contract tenure, HUL doubled its turnover and improved EBITDA margin by circa 1,000 BPS, creating superior value for all our shareholders. In view of the current agreement expiring, Unilever has requested HUL for a review. Unilever remains committed to support HUL through dialed-up access to faster innovation, superior products, technology, and capabilities. HUL board has approved new royalty and central services arrangement effective 1st February 2023 for a period of 5 years after detailed due diligence led by HUL senior management and guided by HUL's audit committee and board. The board also took into consideration an independent external benchmarking which indicated that the new arrangements continue to be competitive versus comparable transactions. The arrangement provides for an 80 BPS increase in the effective rate from circa 2.65% to around 3.45% of turnover. This increase will be staggered over a period of 3 years. The new arrangement is subject to appropriate regulatory approvals. Now moving on to our outlook. In the near term, we remain cautiously optimistic. If commodities were to remain where they are, we believe that the worst of inflation is likely behind us. This augurs well for FMCG industry and should aid in gradual recovery in consumer demand. Having said that, we must be mindful that year-on-year inflation is still high, and so we expect growth to continue to be price-led. We will continue to manage our business dynamically with focus on ensuring right price-value equation for our consumers and building back gross margins. We will keep investing competitively behind our brands, leading to a step up in A&P investments. We remain focused on delivering 4G growth that is consistent, competitive, profitable, and responsible. With this, I complete my prepared remarks, and now we can take questions.
Thank you, Ritesh. Mangalam, would you like to go first, please?
Yeah. Yes, sir. Thank you so much for detailing the outlook as you see it, and congratulations on what was a resilient performance in a challenging environment. The joker in the pack this time around was the royalty arrangement. So before I speak about demand and the way you see it, just wanted to know that this 80 basis points improvement or increase in the royalty that you will be paying to the parent, is there any way that there could be you going back on that if shareholders do not like it? Just wanted to know about that. And then you can obviously talk about the operating environment with regards to whether you view recovery to be gradual or will there be a spurt given the sort of decline that we're seeing in inflation, and how much of the raw material savings will be plowed back into advertisement, and do we see margin improvement from here on? So on the demand environment, operating environment is one, and the other one is with regards to royalty.
So, Ritesh, let me talk about the demand.
Sure.
And then you could pick up on the other thing.
Sure.
Mangalam, first is my greetings to all your viewers. If we were to look at the preceding quarter, the September quarter, and the MAT numbers, then broadly, if we remove the decimal points, here I'm talking about the market growth. The value growth was about 6% and the volume growth was -6%. So we are talking about the difference between the two is the price growth. What we have seen in the December quarter, that the value growth has moved from 6% to 8%. And this has been driven primarily by volumes where the decline has come down from -6 to -4. Now, this augurs well. Yeah. Now, whether it is an established trend, and this change we are seeing both in urban and rural market. And rural market, as you know, the decline was far more accentuated. So even the improvement has been bigger in rural as compared to urban. And if this trend remains, then it certainly augurs well for the industry. So that's on the overall demand is concerned. Now, there is another aspect which I want to cover with you, which is inflation. When we look at inflation, and we have often referred to net material inflation, and net material inflation, if you look at for the last 6 quarters, September quarter 21, December quarter 21, the net material inflation was about 11%, which was still very high compared to the prior periods. But then in 22, it moved to 16%, 20%, 22%. But the good bit is in the December quarter, it has come down to 18%.
Right.
So what we are seeing is that the inflation is, still at a very high level. 18% NMI is very high, but it has stopped increasing, and the trend is now moving southwards. Again, the volume growth and the inflation will be inversely correlated. If the inflation goes down, I believe the volumes will pick up. So that's on the macro environment.
Yeah, let me pick up now your question on operating environment. So overall, Sanjeev mentioned that commodity inflation is moderating sequentially. What are the implications of this? There are 3 implications. Number 1, in short term, as commodities are moderating, we will focus and build gross margins back. In the current quarter, as Sanjeev mentioned, when sequentially NMI reduced from 22% in September quarter to 18% in current quarter December, we have seen in that period, we have improved our gross margin sequentially by 170 BPS. For us, that's a first focus area. The second focus area is also to ensure a right price value equation. Now, commodities, of course, are overall moderating, but there are multiple different dynamics. Where if I look at December quarter, home care and HFD, in these portfolio, we've seen sequential commodity increase overall, the impact, including the impact of US dollar strengthening. In these categories, in December quarter, we took sequential price increases. But when I talk about vegetable oil, which has seen meaningful correction, and hence in December quarter, we have taken price corrections and price decrease in vegetable oil, like we have done for the last couple of quarters on tea. So skin cleansing pricing linked to vegetable oil price coming down, we have taken price decreases in our soaps portfolio and in our tea portfolio. Now, if I put all this put together, the focus for us continues to remain that to keep growing consumer franchise and keep our margins in a healthy range. So that's on the operating environment. The second element of that is on price growth. And as you've seen in the current quarter, we have declared a total growth of 16%, which has 5% volume growth, and hence inferring of that is 11% growth in price. What we see from here on, the price growth will be lower from here on going forward as we are seeing commodities moderating. And to Sanjeev's point, the way the volume and the price equation for the market will settle down, that's something that we have to see in times to come. And lastly, a question on royalty. Royalty today, as we announced, has been approved by the board. Royalty and overall the arrangement has multiple components. It has a component of royalty, both for the trademark and for technology. It has a component of also central services. Now, these arrangements, as I mentioned, are subject to appropriate regulatory approvals. But today what we have is approval from the board, and that's the number that we shared. Overall, an increase of 80 BPS, and this 80 BPS increase will be staggered over the next 3 years.
Yeah, so I just wanted to follow up on that itself. Is there any way that, say for instance, the street does not like that, is there any way you will look back at this royalty, or currently it's cast in stone? Or should I look at it this way, that despite the increase in royalty, you are so optimistic about the performance going forward that it won't impact, the operating performance of the company going forward?
So let me, Mangalam, pick up your second question.
Right.
Yeah, the last royalty increase and the service fees increase, all this took place in 2013. And during this period, 2013 to now, we have doubled our turnover and we improved our operating margin by nearly 1,000 bips.
Right.
Now, we have a symbiotic relationship with Unilever, and we have access to great brands, we have access to great technology, product superiority, is great managerial, technical services that come to us. So these are of immense benefit to us, which enables us to create the competitive edge that we have in the market.
I just read it in a way that this is an arrangement for the next 5 years, and in the next 5 years, maybe your revenues grow by 50% and margins improve by 500 basis points going by the past. But then that's again on a lighter note. Back to you guys. Thank you.
That's a wrap on this edition of Business 360. Many thanks for watching, but stay tuned to CNBC TV 18. The news continues on the other side.